It is March 28, 2026, day 28 of the Middle East conflict, and the global financial architecture is undergoing a violent stress test. The immediate catalyst is the closure of the Strait of Hormuz. Maritime traffic lines flatline, reflecting a 95% shipping collapse. This supply shock has mathematical consequences. Brent Crude has surged 53%, crossing the $112 threshold as Tehran establishes a waterway toll booth. Adding to market anxiety is a deliberate geopolitical delay. U.S. strikes on Iranian energy facilities are postponed until April 6 to allow for backchannel diplomacy. The convergence of $112 oil and shipping paralysis creates a stagflationary pincer. This exogenous shock breaks historical market correlations. The sudden spike in energy costs is triggering rapid algorithmic de-risking, forcing a structural decoupling across global macro portfolios. In the United States, equities are buckling under the pressure. The S&P 500 has concluded its fifth consecutive losing week, the longest negative streak in nearly 4 years. Looking at the daily chart, we see a decisive breakdown below the 200-day moving average, pushing the index down to 6,375. Internally, the market is aggressively rotating. Capital is liquidating from technology names like Amazon and Meta, seeking refuge in energy proxies like ExxonMobil. The underlying threat here is monetary. Oil holding above $110 is rapidly de-anchoring inflation expectations, right as the Federal Reserve contemplates a hawkish hold. Across the Atlantic, Europe faces a more immediate physical threat. Germany's DAX has retreated to 22,300, caught in an existential margin crisis. The effective blockade of Qatari LNG exports through the Gulf has sent European Union natural gas benchmarks skyrocketing by 128% this month. This is causing a structural derating of the European automotive sector. Giants like BMW and Volkswagen are trading at multi-year lows due to severe supply chain paralysis. Western markets are effectively trapped in a vice. They are absorbing imported logistical inflation, while their central banks lack the flexibility to ease liquidity. Japan carries a unique geographic vulnerability. The nation relies on the Strait of Hormuz for 90% of its crude oil shipments. This bottleneck places the Nikkei 225 directly into what we call a currency energy trap. This chart illustrates the problem. A weak yen, nearing 160 to the dollar, traditionally aids Japanese exporters, but the astronomical cost of importing fuel at current energy prices entirely erases that advantage. The Bank of Japan remains deadlocked. Attempting to defend the currency now risks crashing a domestic economy that is already hypersensitive to the war shock. When a physical supply blockade occurs, historical foreign exchange advantages are mathematically neutralized. Asian industrial margins are being forced into structural decay. This chart tracks the Saudi TASI index, exhibiting a clean bullish trend. Bouncing off its moving average at 10,830, it has decoupled from Western equities. The fiscal driver is straightforward. Brent at $112 ensures massive sovereign surpluses and high dividend visibility for regional heavyweights. However, institutional size remains capped by tail risk. Explicit threats to regional desalination plants are currently being priced into long-dated derivatives. Capital not flowing into Gulf equities is aggressively rotating into universal safe havens, specifically physical metals. Spot gold is acting as the ultimate hedge, surging 45% year-over-year to reach $4,495 per ounce. Meanwhile, silver enjoys a dual bid status. It is functioning both as a monetary hedge against fiat currency and an industrial safety asset. Institutional capital is aggressively rotating out of vulnerable technology sectors and into localized energy monopolies and physical commodities. To understand the mechanics of this liquidity crisis, we turn to the Indian equity market, which is currently acting as the ultimate stress test for domestic capital against global gravity. Technically, the Nifty index has formed a bearish Marubozu on the daily chart. It has slipped below its 10-day moving average and is now threatening major structural support floors. This price action is driven by an institutional wall, a direct tug-of-war between retreating foreign investors and aggressive domestic institutions. On March 20th, domestic funds successfully absorbed a massive 5,500 crore foreign sell-off, holding the wall with a positive net delta. But advancing to March 27th, the safety net shrinks. Aggressive foreign outflows overwhelm domestic buyers, resulting in a negative 801 crore net delta. This capital flight is being exacerbated by localized macro failures. The Indian rupee has crashed to 94.82 against the dollar, amplifying fears of fiscal slippage from the union budget. Borrowing costs are rising in tandem. 10-year bond yields spiking to 6.9% are crushing high-beta non-banking financial companies like Shriram Finance. In response, domestic institutions are abandoning growth and hiding in the IT and energy sectors, treating tickers like ONGC as defensive bunkers. Even the most robust domestic liquidity walls have a mathematical breaking point when subjected to a sustained exogenous energy shock. Looking ahead to Monday's open, behavioral data points to a gap-down resilience play as global markets test their structural floors. This dashboard tracks the critical technical fail states. We are watching two specific levels: the S&P 500 failing to reclaim 6,450 and the Nifty closing below 22,800. Breaching these levels confirms a formal transition into a structural bear market. For tactical positioning, contrarian plays exist in the aviation and paint sectors, but these are liable only if oil begins to cool back toward $95. Market liquidity will be dictated by two immediate catalysts: Federal Reserve Chair Powell's scheduled remarks on Monday and the outcome of the April 6th diplomatic window for military action. Until the physical bottleneck at the Strait of Hormuz is cleared, professional survival dictates maintaining maximum cash ratios and zero reliance on traditional risk-on growth models.